Now from the Australian Stock Report. He joins us in our discussion now live out of our Melbourne studio. Chris, get involved in this discussion because, of course, you know, you've been watching markets as well, and I'm just wondering where you're putting your money, how you're putting your strategy at the moment forward, given what we're seeing on global markets, where we're seeing this Treasury yield story in the United States, but earnings very strong there, and then obviously how that flows through here at home to our market.
Good afternoon, team. Good afternoon, Ingrid. Look, I would tend to agree with Rudy. I think this 3% number is largely irrelevant in the grand scheme of things, and sort of to reinforce Rudy's points with some data. Now, this is not my research, but it is timely research, and I think it's worth talking about. There was some research I was reading earlier in the week that suggests that that relationship between bonds and equities doesn't reach critical mass until yields get to about 5%. Since 1996, there's been 11 periods of rising interest rates in the US. And through those periods, up until, as I said, yields reach 5% on the 10-year, equities have rallied in unison with yields moving higher. So again, we've just got to remember the relationship here. It's about, you know, investors shunning riskier or perceived to be riskier equities and putting it in the relative safety of bonds, and that doesn't happen, you know, en masse, I guess you'd say, until that yield reaches 5%. So there is some strong data there to suggest that, you know, US equities at the very least can continue to run higher. Again, as Rudy mentioned, there will be bumps along the way as we wrap our head around these big numbers, 3, 3.5, 4. But ultimately the data shows, you know, it's 11 out of 11. It's a pretty good strike rate. And if that positive sentiment remains in the US, then, you know, that'll translate to, I think, a higher equity market here as well.
I mean, looking at, just want to switch gears to the banks now, because that's obviously such a big part of our market. The banks and the miners, as we know, index weight-wise, making up most of the Australian market. And we are seeing the banks lose ground today, particularly Westpac, Rudy. And I've got to mention this one because it had a downgrade, obviously, by UBS. It comes at an interesting time because today we've seen APRA change its rules for investor housing.
Perfectly
just
timed.
as we hear that
Westpac
was an outlier, according to them. So what's your take on Westpac today? 3% weaker. I mean, it's certainly taking a hit. Downgraded to a sell by UBS.
Well, what I noticed as well is that target prices are coming down, where investors would have thought even 2 or 3 years ago, like, oh, Westpac at $26, that's a good buy. You can't go wrong there. Now the target price actually is $26.50 for UBS, and they're also coming down for other banks and elsewhere, I must say. So sometimes, if the asset looks cheap, it never gives you the reason why, and it doesn't give you the timing when it will recover, and it doesn't particularly exclude the fact that assets can get cheaper. Right? And if there's more bad news from Westpac coming, and UBS essentially is suggesting that is the case, then a share price near $30, where a lot of people would have bought Westpac thinking they were on a cheap asset, it can get cheaper.
You know, it's interesting, Chris, because, you know, when we talked about the Royal Commission in the lead-up, there were a lot of analysts and commentators on the show saying, look, it probably won't have much impact on share prices. And I think the things that have been coming out of the Royal Commission have been a lot more severe than some might have expected. Today, you know, obviously I mentioned hearing, you know, after analysts have reviewed these subpoenaed exhibits to the Royal Commission, including APRA, and seeing that, you know, Wayne Byers described Westpac as a significant outlier when it comes to its loans, with much weaker underwriting than they believed, and talking about their high proportion of LVR and interest-only lending, that has clearly hit the share price. I mean, when you see UBS go to a sell on one of the big 4 banks, it's a pretty big move.
Yeah, absolutely. Look, to the point about the Royal Commission, Ingrid, yeah, at the point of impact when these revelations are made, and we all think it's shocking, you know, obviously it's having an impact on share prices in the near term. I wonder what that impact will look like in 12 months' time, because again, this is a 12-month process, and you know, I think the shock value of some of these things will wear off. More to the point with Westpac and sort of the banks more broadly, it really points to just how hyper-competitive this space is. And it reminds me a little bit of the telco space not long back, where, you know, there's a finite number of consumers here in Australia. And so they're fighting rapidly amongst themselves to try and get their piece of the pie. And obviously in the case of Westpac, they've, you know, maybe don't have, or clearly don't have, as good a lending standard as the other majors. But it just points to that hyper-competitive environment. And you know, when we're talking about low growth or no growth for the banks, the question begs, where are the revenues going to come from? Where's the growth going to come from? They can't keep cutting costs forever. So yeah, I'm pretty negative on the banks, both in the near term and even in the longer term as well, because whilst the sentiment around the Royal Commission will wear off, I think there are some bigger problems that we need to deal with.
What do you think, Rudy? I mean, do you agree with that? Would you be pretty negative on the banks in general?
I think the definition here is what is long term. Yeah? I have been personally not very supportive, let's call it that way, of the banks, and I also note that on a 4-year horizon, I mean, you have capital losses. I mean, the only returns you have on those banks is a dividend yield. I do think that in the coming years, the banks will go through a transformation period where they have to reinvent themselves, and it is probably likely they will come out of that period in a stronger position, but they first have to go through that period, and I think that might take 3-4 years, if not longer. And I mean, and that is your long term. So maybe if you define long term as beyond the next 4 or 5 years, that could actually be a positive story for the banks. But I do think between now and then, I wouldn't have too high expectations myself. So I would agree with that view, yes.
All right, in terms of moving on from the banks, another one we're watching today, Chris, is Wesfarmers, of course. This stock down about 0.6%, coming out with numbers, and Coles actually looking a little better in terms of the numbers today, but Bunnings still looking like it's suffering. What did you take out of those numbers today, and how it's impacting, obviously, the share price today?
I think on the whole, Ingrid, the numbers were solid. I think it was 2.7% like-for-like sales across all of Wesfarmers. So, you know, I wouldn't say it was a poor result. And then you've obviously got pockets of strength and pockets of weakness. So Kmart good, Bunnings Australia good. I think it was Target bad, and obviously Bunnings the UK is turning into a fully fledged disaster potentially. I'll put my trading hat back on. Wesfarmers, for me, it's very simple. It's a buy at 40 and it's a sell at 45. You look at the price action over the last 12 months, it has been range bound for that entire period. So for me, it's just a little bit of pushing the numbers aside. They're largely irrelevant. You've got some pretty clear markers in there where you should be, you know, buying and selling this stock.
And what do you think, Rudy, when it comes to Wesfarmers and the news out today? Because obviously it's very topical given we're watching Coles and that spin-off, I guess, or IPO of Coles later in the year.
Yes, so the good numbers from Coles means they probably get the spin-off away at a reasonable valuation. That's a positive. I think the market got a little bit of a shock again by Bunnings in the UK, and that's obviously negative, but that can be turned to a positive. If they have an investment day coming off, on strategy day, whatever they want to call it, if they announce on that day they're gonna exit the UK, I predict that the share price will rally. Yeah? People will be happy that they get rid of their. I also think that trading range that Chris was referring to has been in place now for 4 or 5 years. That's not going to remain in place forever. Yeah? Once they spin off Coles, and if they manage to reallocate that money in a positive way, they will get new momentum. But at this point in time, you will have to trust that they can and will do that. And at this point in time, of course, that's just a matter of trust.
Would you want to see them, Chris, if you own Wesfarmers? I don't know if you do, but if you do own Wesfarmers, would you want to see them get rid of Bunnings altogether and just, I guess, abandon Bunnings UK?
Yeah, I think so. Look, I mean, obviously we equate this one to the Masters debacle here in Australia, and you know, I remember distinctly saying at the time, why do these companies think that they can take an Australian idea, an Australian business model, and go and implement it in a country just because they speak the same language as us? As I said, I distinctly remember being on the show saying that. And obviously it hasn't turned out, and yes, it does have the potential to turn into, you know, the same scale as the Masters disaster. So yeah, I would really like to see them exit that business. They've had a crack at it, it's not working, take your lumps and move on.
I think there's a long history of Australian companies making that exact mistake. And what shocked me is that the news, so to speak, that came out of the UK was actually that these guys have hardly done any due diligence, or very, very clumsily. And that doesn't really reflect.
Well, and they got rid of all key management straight up, which
exactly.
You meant to keep them in transition. That's 101, isn't it?
That really does not reflect.
Have we seen many successful moves from Australian businesses into overseas? I feel like there's been a lot of unsuccessful stories. Maybe the successful ones don't make as much.
We do emphasise the negative ones because there's a lot of failure out there, but it's probably good to say we have some of the world-class companies here as well. CSL, Westmed, Cochlear, they all went international, Computershare. I mean, they all went international, and they all have very solid business models which they have replicated overseas. What
do you think, Chris, about the future of Coles and I guess investor appetite, how that will look for Coles, given these results today, and it's looking somewhat solid, I guess you could say, or more solid than it was?
Yeah, somewhat solid, but there's some discussion there about price deflation shrinking. So obviously them not being willing to cut prices as much as they have previously to protect some margins. So, and that's, I think, speaks to Rudy's point about them wanting to prop that up and get a good IPO price. So, look, I think because of the size of the company and because it's a well-known brand, there'll be plenty of investor appetite for it. But I look across the broader competitive horizon. And, you know, we know all the players that are coming, that are here already, and those that are coming in Little and Kaufland as well. So it just seems to be an ever competitive environment where cutting prices isn't going to be the thing that sustains you over the long term.
I think it's about timing, absolutely. I think everyone knows Kaufland is coming with Lidl, and then you want to spin it off now.
Yeah.
You don't want to wait 2 years.
But do you see investors being interested in it then?
And
what sort of investors?
Investors can be a really strange animal. Like I am personally, and I've seen a lot, I've personally always been very, very surprised that some of the really, really dodgy businesses, they get away with an IPO. I mean, I never know who's buying them, and I do think that they can probably get away with calls, because people are looking at Woolworths and think like, oh well, I mean that after the big scare, it actually has performed relatively well and hasn't been such a big disappointment after all, and it will be presented as a relatively modestly growing, safe dividend payer, yeah? And there's still a lot of demand out there for people who want to have a yield stock.
All right, before we let you go, Chris, quick thought on something you're watching at the moment. I mean, where are you finding value right now? Where are you looking for value right now?
So one we like at the moment, Ingrid, is Link Investor Services. You know, there's a few moving parts here. One of the things we like about them is that obviously when they're holding client capital for share allocations, in their accounts, high yields can actually be a benefit for a company like this. They have raised some money recently and paid down debt, and they're looking for further acquisitions. Obviously, they had the big acquisition with Capita Asset out of the UK last year, and that's proved to deliver some better synergies even than they thought early on. And we've got a bit of market activity at the moment, and possible M&A as well. So, like I said, a few elements there, and we think it's offering some value.
Ready?
It's one of my shareholders in my portfolio, so I know Link quite well. I do think people always make that comparison with Computershare, but I think you shouldn't do that, because that's, in Link's case, it's only a minority of the business. The majority is servicing super funds in Australia, and that's a very reliable and consistent source of revenues, and that's why you own Link.
All right, Chris, we've got to leave it there with you, but appreciate your time on the program as always. Thank you.
Cheers, guys. Thank you.
Chris Conway there from Australian Stock Report.